Hi, once again, it's Andrew Overman at Location, and my good friend, Michael Webb, over at Mortgage Republic. Each week, we dip into the minefield that can sometimes be mortgages to answer your viewers' questions. And this week, we have an investment buyer's question. Michael, getting a buy-to-let mortgage, what are the rules and how are they different from a normal purchase mortgage? Getting a buy-to-let mortgage, what are the rules and how are they different from a normal purchase mortgage?
Okay, so I think it's best that we start with the regulation on these mortgages. So a residential mortgage, so for a home you're going to live in, will be a regulated by the FCA mortgage. A buy-to-let is technically unregulated and treated as commercial finance. However, that said, the Prudential Regulation Authority did take oversight of buy-to-let mortgages some years ago. So whilst they are technically unregulated, there are regulations that apply to them. So overriding affordability regulations, we could call them. So typically, and I'll talk typically because deals pop in and out of the market. And so very typically, you would need a 25% deposit. And I'm going to stick with typically, but that's not to say there's not 80% deals and sometimes 85% deals in the marketplace. Okay. So, but broadly speaking, 75% loan to value is required or below. That money needs to come from a verifiable resource. You can't borrow it in most cases, unless of course you're borrowing it against something that an asset you already own. So for example, you can remortgage your own home to take out a deposit to buy a buy-to-let, and numerous people over the years have done that. But what I'm saying is you can't go to HSBC, take out an unsecured loan and then put that down on a house. That would be an unacceptable form of deposit for most lenders. So the buy-to-lets are then going to have varying criteria, okay, and it really is varying. So from an applicant point of view, you're going to be credit checked, credit searched or scored. The lender is then going to have income criteria, so your basic income criteria that will vary massively from 0, but you've got to have something, to 25, 30, 40,000 minimum. Okay. But very commonly, if there is an income requirement, it's 25 to 30,000 base income required. You'll then have the overriding affordability check on a buy-to-let is done against the rental received and the mortgage payment. So this is where it gets a little bit complex to explain without a whiteboard. But if we imagine your so how's best to do this? So there's a calculation that the lenders will use. Those calculations again will be different lender to lender, and more specifically product to product. So some products will have different calculations. Very typically, this calculation requires your mortgage to be 145, or sorry, your rent to be 145% of your mortgage payment on interest only at a 5.5% interest rate. Let's do some maths. So we'll use the phone. If we have a £100,000 mortgage, so £100,000 mortgage times 5.5% gives us £5,500. Could have done that without a calculator, just so you know. Times 1.45, so that's your 145%. Yeah. And then divide by 12, the rent would have to be, broadly speaking, £665 a month for that mortgage to be deemed affordable by the lender. That is a very common calculation used, okay, but there are different variations of it, okay, i.e. the 5.5% can change upwards or typically downwards. The 145% can change upwards a bit, downwards to 125, things like that. So it's lender by lender, but that is the most kind of, broadly speaking, common variety. There are ways to improve that calculation, i.e. making it less difficult to hit with the rent. And that is by one, going for a 5-year fixed. Lots of lenders improve the calculation for that. So they don't use 5.5%. They use the actual rate that you're securing for the 5 years, which would be significantly lower. Therefore, the rental requirement is lower. And this only really becomes a problem if you're buying in a really high value area and the rent doesn't track that area. So if you're buying a £400,000 house, but you can only achieve £1,200 rent for it, well, firstly, you need to question whether that's a good investment or not, but also that's highly unlikely to stack up on a lender's calculation. Whereas you could also be buying an £80,000 property in Wales somewhere that's going to rent for £550, and irrelevant of whatever calculation that will fit. So there's different things to bear in mind. There's other things to look at as well, criteria wise, and I mean this could be hours that I could talk about the criteria around buy-to-lets. And if you actually want a bit more information, a completely shameless plug, if you go on Amazon and look for the Property Investors Finance Manifesto, it's a book that I've written on buy-to-let mortgages. So that's available on Amazon. And we're going to a lot more depth. The other kind of overriding criteria they're going to look at is, are you a first-time buyer? You can get a buy-to-let mortgage if you're a first-time buyer, but there's additional affordability that will come into play, which will match the residential affordability. So you have to fit 2 sets of criteria. Are you a homeowner? Is there a risk that you will move into the property? That is something that only the underwriters can establish, and it will be down to the underwriter's individual risk. And is there a demand for rental for this property? So when they do the survey, you'll get 2 valuations. You will get the property valuation and the rental valuation, and an overriding, is there demand for this property? Because if there isn't a rental demand in the area you've purchased, then the mortgage may be declined for that reason, because there's risk it will sit empty, and therefore that can put affordability pressures on you paying the mortgage.
Brilliant. In essence, a buy-to-let mortgage, there are more hoops to jump through than a normal residential mortgage. There are more criteria to hit, albeit an unregulated type of mortgage. And the best advice that we can give is get in touch with a broker earlier, because the earlier you speak to that mortgage broker, the better informed you'll be, and the better decisions you can make as to whether to invest in area A or area B, or property type A and property type B. As always,
I think it's really important actually to point out that there's not many lenders you can go direct to get a buy-to-let mortgage because of their regulation status. So I can't even think of any off the top of my head. There's probably a couple, maybe HSBC, someone like that does them. A few of the lenders that don't deal with brokers, maybe. But when we look at the spread of broker to direct business, residential's moved over the last 6 years from about 50-50 to way above 80% in brokers' favour. I would go as far as saying, and this is anecdotal, I don't have the official stats, I would go as far as saying 98-99% of buy-to-let mortgages are done via brokers. And a lot of the lenders that operate in that field will only be broker led. You can't go direct to them. You have to go via a broker.
So that's great advice there, Michael. If you are considering an investment or a buy-to-let purchase and you want to know what the rules are surrounding the mortgages and how they differ, do get in touch with Michael. The web address is allthews.mortgagerepublic.co.uk. I'm Andrew Overman. He's Michael Webb. And together we've just discussed mortgage matters surrounding buy-to-let mortgages. Thank you again for your time, Michael.
Thank you, Andrew.